here's my attempt to try and give some perspective onto the mutual fund flows that we saw yesterday. For all of those who missed because they came in the second half of trade, these are the two most important snapshots that you got to monitor when you look at the flows that came in, because they declined by more than half for the month of November as investors plowed back some of the profits that they would have made. Look at the chart and it shows you because less money was put in both equity and liquid schemes. Now this is the flows into equity funds, and as you can see from a number of circa 8,000 crores that we've seen almost staying constant for a while, from a peak of 11,756 crores in the month of March 2019, the flows, these are the net mutual fund flows, they've declined to 1,312 crores for the month gone by, and that's a telling downtick into what's happened. And this comes on the back of flows into systematic investment plans or SIPs continuing to be steady. That number has still stayed above that 8,000 crore mark. As you can see, since April 2019, we have been above this 8,000 crore mark, and for a better part, we are above this 7,500 crore mark any which way. So, despite SIP flows coming in at a healthy 8,000 crores, we still had net inflows of only 1,312 crores. And why this happened? Well, just to give you a math before I get to the reasons, balanced funds saw an outflow of 4,500 crores. There is an inflow of about 1,300 crores. That means that it accounts for 5,800 crores of the explanation of where the SIP flows went. What is not there is the 2,500 crore differential between 80,200 crores, 8,200 crores of the SIP flows and the remainder. So that was the quantum of outflows that went out from mutual fund schemes, equity mutual fund schemes, for the month gone by. Now, why has this happened? What is likely working against mutual funds in India? Now, one, that unlike the past, intermediaries, which is the independent financial advisors as well as bank intermediaries, because mutual funds are sold through bank branches as well, those intermediaries now have a lot more options besides mutual funds, because insurance and ULIP plans have made a comeback with a big way, in a big way, and the compensation structure for these intermediaries is skewed against mutual funds. Now, why do I say this is the question. Now, I spoke to a few intermediaries, 4 intermediaries who sell both mutual funds. There are 3 intermediaries who sell both mutual funds and insurance products and bank FDs, and 1 intermediary which sells only mutual funds. Now, this is the feedback that I got from them. Look at, this is for an illustrative purpose, but look at the kind of compensation structure that is there. The standard compensation structure, albeit there would be some variance out here for some of the other schemes as well. But for ULIP products or insurance products, the upfront commission is 7% and the renewal commission every year is 2%. Assuming that the insurance policy is for 10 years or 12 years, ULIP plan, the insurer or the intermediary gets a hefty commission upfront and 2% every year. As against that, for a mutual fund product, remember, the upfront commission was banned in September 2018 by SEBI. So there is 0 upfront commission, and there is an annual commission of 1%, which is split into monthly divided by 12. So that's the kind of compensation that an advisor or an intermediary gets for selling a mutual fund product. Now, well, for a bank which has target or intermediaries which have targets to achieve, the simplest and the best way to do would be to not sell mutual fund products necessarily, but go out and sell insurance products or bank FDs as well, if that works. So there is competition amongst competition of products and options between the advisories as well. That aside, you have to agree that the sentiment on the equity markets has weakened a bit, and that would also play a part. A lot of people said that since the markets have come up to 12,000, let's go out and book those profits, because of the GDP growth, so on and so forth, we may not see the markets moving ahead, and that is a key thing as well. So you got to keep that in mind. I mean, the buy right, sit tight philosophy is working for SIPs, and people are sitting pat in the SIP structures as the flows show, but not for the other modes, which is lump sum or parked money into the funds which are being pulled out as well, and which probably explains the dwindling inflows into mutual funds. You have to admit though that performance also plays a part here. Most of the schemes, large cap, mid cap, small cap, save for a few, haven't really delivered returns, and at some point of time, investors who were promised that mutual funds sahi hai and the money comes in will take a step back and think that, is this the right option or should I go for other things? And which is why even there, the money from at least the underperforming schemes would have been brought out. The last thing you got to monitor is liquid funds, and there was a dramatic downtick. No surprise out here, simply because the exit load that has been levied on liquid funds would mean that these are not a very attractive option anymore. Now, when you look at this chart, don't look at the negative number for the month of June, which is 1,52,000, because at the end of every quarter, there would be an outflow from liquid funds. So that's okay. But usually, liquid funds numbers, inflows were very, very strong for the 2 months of the first 2 months of any quarter. Now that number has come down to 6,938 crores, arguably because of the exit load. And it might well be the case that here hitherto or here going ahead, we might not see the erstwhile high numbers of northwards of 50,000, at times even 1 lakh crores into the liquid funds, because the exit load dampens the returns that a liquid fund is able to give in the short term. Maybe bank FDs, maybe call money markets are the options which investors might be choosing, but certainly liquid funds will not be an option. And I think a reaffirmation of the trend will be seen in the months of January and February. December may be a slightly different month, but January and February, the liquid fund inflows will also, to my mind, reaffirm this trend as well. So a few factors working against inflows in the mutual funds. For long, we've been saying about how the backbone of the Indian markets would be the constant inflow of equity money from Indian investors. That is now starting to get a bit challenged.